Thank you, gentlemen, for tuning in. For all of you that are listening or watching and online, you are welcome to send your questions either through the chat or through email. We will respond to those. I'm Dave Snider of Chateau Capital, and you have Cory Whitesell here of Chateau Capital. And we'll be sharing today a little bit about some ideas that we think will greatly benefit you. I'm going to start this Zoom presentation, and Cory and I will be speaking a little bit more here in just a short minute. But some have asked us why Chateau Capital. I think my wife wanted to make sure that our residents had a superior experience. The idea that Chateau was a superior house style for the French people, and our Biltmore estate has that style. We invest carefully so you can earn more, worry less, passively, repeatedly, purposefully, and tax efficiently. We've been investing for 29 years in real estate, and for the last decade have been paying out five figures monthly to people who invest in real estate on a private basis, either as limited partners or as promissory notes on the debt side or equity side, both. So we will enjoy bringing this idea to you today. We want to do a legal disclaimer that neither of us are acting as attorneys or CPAs. I think I did stay in a Holiday Inn Express one time, so that maybe that would qualify me, but I'm really not acting as that today. Cory actually has been a CPA for decades, but we're not acting as your advisors today. We encourage you to seek your own professional counsel. If you would like, we can point you in the direction of those who actually have real estate experience, who also do tax law and accounting. Here's a question I would ask you. If you have an interest in learning how to invest in real estate passively, you could ask your browser or your phone or your device, where the majority of the 2020 to 2022 multifamily properties acquired through variable debt. The answer is yes. It's kind of small to read on the screen there, but the majority of multifamily properties acquired, the reason they used variable debt, which is a real no-no, that's what got us in trouble in the '08 crisis, was rates were at historic lows, down around zero for the Fed funds rate, and they had been so for a long time. So many people assumed they would never go up, whereas just after that, in 22, the Federal Reserve Chairman began raising rates at historic levels for 11 straight times. And when they did, that has created a lot of properties now that are going into default financially. Nothing wrong with the properties. It's just they need a new owner who can get different types of debt. So that's what we're doing. During 2020 to 2022 or three, we bought a lot less, Cory and I. We still bought some, but the metrics had to be written. We wrote down what we did not want and what we did not need, and decisions were made based on metrics. Emotions are not allowed. So we work inside of the guardrails. And so we were not buying properties and not using variable debt, just something we're adamantly against. And I'm Dave Snider. I'm going to introduce Cory here in a second. I've been investing in real estate for almost 3 decades. I learned it from my parents who were in ministry and education. They invested in real estate and it did super well for them. I started buying foreclosures in the late 90s and went from one county to 7 counties while I was a seminary student. And we went on from there to manage rentals, and we have rentals in the Western, Central, and Eastern North Carolina. We have had them in other states. We do have one in Hilton Head. We've had them in Georgia. We've had them in New Mexico. But nonetheless, we've been paying out capital to investors for a decade on a monthly basis and continue to do that. We've been stewards through lots of cycles of all kinds of hurricanes, floods, fires, tornadoes, you name it, economic recessions. Cory is a former CPA. Cory has a master's in taxation and finance from Brigham Young. He practiced as a CPA and a senior tax associate for Deloitte for a number of years in Costa Mesa, and then transferred to Charlotte, became the senior tax manager for Wachovia, and then the senior tax manager for Wells Fargo. Here in the last decade, he transitioned over, having seen enough returns of what he liked, into just buying commercial real estate, restaurants, commercial office buildings, multifamily, and so on around the area. He lives near Charlotte and Greenville, South Carolina, Columbia, South Carolina. So we know these are North and South Carolina markets, and his focus is on structuring after-tax outcomes for investors. And we focus on investment opportunities with superior passive returns and superior tax benefits and superior capital preservation and tax efficiency. And we put our money into every one of these. So we design investments the way we manage our own capital. Cory, I'm going to stop the share and just let you share a little bit about one of the questions that comes up inevitably is, why are you a good operator? And you've been through a lot in addition to raising 4 kids and all the responsibilities you've had. What trials have you come through, and what makes you a great operator, as I know you are?
Thanks, Dave. Yeah, so as an operator, as Dave mentioned, I've been in that space actively for the last 10 years or so. Prior to that, let's say I had my toes in it a little bit, but not a lot. So just a few forays into it. I think what makes me a good operator is the experience that I have from a financial perspective as far as understanding numbers and being able to forecast and project and paint the picture financially for what the likely outcomes in the future will be based on what we're experiencing currently and putting other forecasts and so forth into play. So I think that helps from the financial side, from the getting your boots dirty and doing that type of work. I've really done a lot more of that about 10 years ago when I got into the commercial space with properties that need work. When I first started out, I was doing more of that work. And as you grow, you get teams to help you. And the successful thing for me, what I believe makes me or anyone a good to a great operator is having a team that you can count on that you work well with. So I realized early on in my journey as an operator, I could only get so much done, but there was some phenomenal people that were a lot better at things than I was, whether it's repairing things or helping or whatever it is, insurance, brokers, people providing debt, providing other expertise that obviously I did not have. So I think the key for me is the team that we have that helps us be successful. And that team is everything to me. I can only do so much, but I love my team and I love what results we get when we work together. And what gets me excited is working with the team and knocking the problems out, having the problems, figuring them out, and moving forward. That's what really gets me jazzed up and excited.
Corey, have you navigated through fires, floods, tornadoes, hurricanes, COVID and pandemic disasters? And if so, how did you survive?
We Dave, we've done a lot of that. I'll share what we've recently experienced in the Greenville, South Carolina market. We have a commercial building that we bought and began to work on, and we had the contractor, the classic contractor that was there and disappeared. And when I mean disappeared, wasn't there, permits weren't pulled like they should have been, just on and on, lots of things. So that's a most recent thing that we've been through as far as having a property that needed a lot of work. We had the plan, had the contractor. Contractor A didn't perform, contractor B is in there. So we're managing that. And it's very helpful to have a team. So when someone, this was a newer market for us, so we didn't have as strong of a team there. Now we do. So again, the teamwork and understanding who we're dealing with just recently, everything checked out on the front end for the contractor we were using. But over time, he became distracted and had another business interest that he decided to pursue. We figured out that was the issue there. And we're moving forward and we'll be into that property. It's already leased. It'll be operational very, very soon. But those types of things happen often. Almost every project I've been involved in has some element, maybe not that critical, but elements that definitely slow it down, and affect the cost in some way. And sometimes on some of those losers from a financial perspective, we're able to find other ways where we can win. And we did that on this project as well. So overall, financially, we're in good shape.
I would say that we've been through a lot of challenges, and you have to have reserves for that. You have to underwrite for that, which is you have to buy it at the right prices and put the reserves away and so on. And I don't think we would have survived as well had we not practiced those conservative principles. But we have been through the economic cycles. We were buying in '08. I was selling in '07 as we saw the wave coming. We generally just buy on metrics and buy on what is it producing for cash flow. So I'm going to get back to the PowerPoint presentation and just try to run through trying to answer some questions that people have. But we enjoy what we do. And one of the books that I released a little over a year ago, and if you'd like a free digital color copy of that, I can send it, but you can get it on Amazon. It's called Earn More, Worry Less. What I found is the people that invest in real estate love it because they don't have anything to worry about. They're not asking how low is the index today? How high are the valuations of equities and stocks? Just an hour before this meeting, I had my annual review with my managed funds to tell me how well those managed funds have done and how well they're doing on that. If you're living your life based on that, in other words, you save up and spend down, most retirement plans do that. They will ask you to deplete to live, deplete to survive, and you at some point it runs out. If you do that, then good for you. We think there's a better way, and that's one of the things we'll share today, is that income assets pay you, and real estate is one of those. So the people that have invested, they love it and they brag about it a lot. And so I wrote about them in a book called Earn More, Worry Less, and we're working on the book number 2 about the multifamily experience in it. So we're looking forward to continuing the journey with that. In the current market, what we're looking for to acquire must pass 5 tests. Number 1, the acquisition basis or cost is below replacement cost. Number 2, the cash flow coverage covers at today's interest rates very well. In fact, we need to be able to have clear, look at number 5, clear downside protection. That means rents can drop 25% and the property is still profitable and strong. We have to have conservative long duration debt, operational control, as well as other clear downside protection, including adequate insurance for whatever storms, whatever pandemics, or whatever aliens show up and pesterize us. And one of the things I had to do 20 years ago was learn the U.S. tax code, because a CPA like Cory called me and said, "Hey, I need you to send me an additional $60,342 check to get finishing your tax return." And I said, "That can't be, because I think we've already paid 180." And I said, I'm sure we got a mistake there. You don't mean in addition to what I paid." He said, "Yeah, you've tipped into, you're just under $500,000. And that's taxable income, Dave, you're in a 47% bracket." So that's when I began to consult CPAs and tax consultants that knew the tax code and read the tax code. And it points you in the direction of a lot of things you can do that give you incentives to operate, and we follow that. One of the privileges I had as a college student was becoming what's called a college unit director. And what that meant was I recruited and managed 20 insurance agents while I was a college student at UNC Chapel Hill. I would be flown up to Milwaukee from time to time. And in Milwaukee, I got to sit in front of the director of investments for one of the largest life insurance companies in the USA and the world, and he was explaining how their returns are stronger than any other insurance company, their investment returns, and how their expenses were the lowest of any insurance company, and how their insureds were the most healthy, so they could pay ever larger dividends to their policyholders. There were no stockholders. And I raised my hand and asked if I could ask a question. And I was a bit naive. I wasn't quite dialed into what had happened in the 40s, the 50s, the 60s, 73, 74, 80, some of the downturns. And I did have stockbroker friends. I was 21, managing 20 agents, and he allowed me to ask the question. I said, "I bet your team is really crushing it in equities and the stock market, aren't you?" And that was, in hindsight, a pretty short-sighted thing to say, but he smiled out of respect, and he smiled a little smile that said, "Son, you have a lot to learn." And he said, "No, Dave, we really don't." He said, "We're not a spend up and save down, save up and spend down, if you will. We don't do that." He said, "We can't predict when there'll be another downturn, another 1929. He said, "Dave, in case you didn't check it, in the S&P 500, more than 25% of the original S&P 500 are no longer there. They're bankrupt, merged, or something else. I think today, this was in the 80s, about half of the original S&P stocks still hold their original spot." Let me ask you this. If we thought we were smart and we'd invested in the other half, where would we be? Please understand, my role is voted on. You guys vote me into this position. Said we have to protect capital and earn stronger returns in the market with much less volatility than that. And I was surprised. I said, "Wow, then what do you invest in?" He says, "Well, a lot of commercial real estate. A lot of it's on the debt side and the equity side, a lot of private equity, and a lot of that is in multifamily apartments." And so, "Wow, really?" And you'll see on the screen, in 2024, life insurance companies held over $750 billion in these investments in apartments. And in fact, 25% of most major markets of apartments are owned by pension funds, teacher retirement funds, insurance companies, and things like that. And he explained that, "Yeah, this is what we do." He said, "Dave, I'm sure at some point in time you'll learn all these asset classes No doubt you will. He said, you must have some stockbroker friends. He said, but I wanted to thank you for that. He said, I will ask you, do you live in an apartment? I said, well, I do. He said, well, understand, we are investing in assets tied to life. They're not going to be technologically outdated. There was not AI back then, but computer and internet was just coming online, and a lot of people were concerned about what assets would be changed. He said, apartments have been around a long, long time. Let me ask you this. Have apartments gone down since 1945? Now, I didn't really know the answer to that question. I just knew what I was paying because I wanted the privacy. But if you go to Northwestern Mutual's websites today, you'll find if you are interested in real estate and you have experience in real estate, they want to hire you. I didn't know the answer to it, so I said, I apologize, I don't know. He said, well, understand that rents grow over time and values of these properties grow with good management. He said, so we invest in things that will grow gently over time because people trust us with their monies for decades. Policyholders, we have to think in terms of centuries here. So if you do your homework and learn what rents have done, as you notice on the screen, it'll show you from 35 to 37 up to currently 1500 to 1894. There's growth in these properties, and that's why a lot of people like them. A lot of pension funds like them. And approximately 27% of new capital pledged by public pensions are directed towards multifamily assets. I bring that up again because my my financial advisor, who does managed funds, is brilliant gentleman team that has offices all over the place. And they like to put growth stocks into what we call the retirement bathtub, just fill them up with growth stocks. And today I was explaining, said, well, at what point do we shift those over to dividend stock so that, when it's time to start draining, instead of just depleting, as most people do, and you tell me that it'll outlast me, but then be gone, what can we do to get it to where we have money's going back in and replenishing? How can I own assets that pay me? And so we're having those discussions. Who else shares our opinion about that in private equity? Well, Ken McElroy does. Ken is one of the largest owners of multifamily properties in the United States and the world. He's gone from 3 billion up to about 10 billion in the last year or two. He sat out from 2020 to 2024, but in 2025 deployed over $500 million, and again in 2026, well over $500 million or more. And the biggest tsunami of properties coming back to the banks are coming the second half of this year and next year. In fact, the second half this year, it's over $500 million, and next year, it's over 500 billion. Next year, it's over 1.25 trillion in properties coming back that will be changing hands, and we are preparing to do that. Ken McElroy explains that when the Fed funds rate was super low, as you see over here, a lot of people bought with variable debts. And why banks did that, I don't know. I sit with them at Rotary, the former emeritus chairmen of these banks, and I asked him, said, are you guys concerned about this? They said, well, we are. I said, well, why did you offer variable debt? So we thought it was a good idea at the time. And thought, well, when the rates began to go up at historic levels, about midway up, everybody's upside down. They're no longer cash flowing. The properties are doing fine. The renters are doing fine, but the properties are no longer, the operator is no longer solvent. So we do not use variable debt. Who else shares that opinion? Tony Robbins, who wrote The Holy Grail of Investing. He's been interviewed recently on CNBC, and you can hear a little bit of what he says here about private equity. So let's listen to Tony Robbins here. If I will push the
As
right
you well know, for decades, private institutions, big institutions, pension funds, ultra wealthy people have had access, but the general public has not had access, and most of them don't even understand the impact. For example, in the S&P 500 for the last 35 years, we know we've compounded at 9.2%. It's pretty darn good. You're doubling your money about every 8 years. But you've got 14.2%, not with these guys, with average private equity. So imagine getting 50% more per year compounded for decades. So as an example, if you had $1 million and you put it aside in the S&P 35 years ago, forgot about it, it's worth 26 million. Take the same million, same 35 years, put in private equity, average private equity, it's $139 million. So the ability to get much higher returns with less risk, which is what Ray Dalio's part of this book is about, is understanding the math of how to do that. And there's some new rules that make it accessible for people that are general investors.
It's come down, but let's be clear. And you make this point in the book, by the way, which is the private markets are now where the real money is going. Not to disrespect any of our audience and listeners out there that is going in the stock market. I'd take the 26 million on $1 million any day and twice on Sunday, so Tony.
Well, but many people find that 139 million is a little bit higher. Cory, as an accountant, maybe would shed some light on that than the 26 million. And I drew this illustration just showing with an average of 14.2%. I've had folks ask me, wait a minute, David, you got tax drag there. You can't just compound like that. You got to pay taxes every time you sell a property because that's the way it works in stocks. Well, no, you don't. You can exchange it and do a tax deferral. And if you continue to exchange till you die, then your heirs inherit the properties at a stepped up basis and the tax liability vaporizes. So you actually can compound capital dramatically better using these syndication models than you would in equities. And give you an example, I bought a $300,000 golf course house when I moved here a little over 20 years ago. And so in early 2005, when I closed on that, had I put the same money into an average private equity yielding 14.2%, which would be doubling about every 5 years, then my 300,000 at the end of 2000, well, early 2010 would have gone from 300 to 600,000. My $18,000 a month would bump up to about 36,000 a month. So from 2010 to 2015, that $600,000 capital would grow to 1.2 million, and that 36,000 a year I'd be receiving during those 5 years would go up to 72,000. We'd now 2015, you know, as you go to 2.4 million, and then in 2025 be worth 4.8 million. You'd be earning 12,000 a month, and that's considered a return of your capital, not a return on your capital. So these are tax advantaged. It's just giving you that illustration. We are not sorry that we bought the house that we did. I've raised my son on it. It had some level land the boy could play, room for that trampoline and, you know, all that zip line and all that good stuff. Play golf all you want. But understand, had you put your money instead, and we did put our money in real estate and we did some remarkable returns. We're just giving you one simple illustration. If you'd made one $300,000 purchase 25 years ago, here's how well that would be doing using a compounding model. This is not a guarantee. It's just showing you the model that Tony Robbins is talking about. Here's the reason we like buying right now. There's only been 2 times in the last 40 years or 45 years that there's been dips in multifamily properties, and it was because people bought with variable debt and they got upside down. They're giving them back to banks, or they're selling them for pennies on the dollar. They just walked, they haven't been maintaining them. Cory and I have looked at some that have been badly maintained because people ran out of money. So we're buying great assets and great locations. And this is why we're excited about buying now, and why we didn't buy. Notice in the run-ups before, we weren't buying much. I was seeing people make insane offers. I'm thinking, well, there's just no way they're going to be okay long-term unless they got really deep pockets. Caleb Troop is a senior managing director at Berkadia, and he says a telling stat is that over half of the broker owner values they're asked to evaluate are distressed assets today. And so most of the properties available are distressed assets. So why now? Why would we be buying in 2026 when we didn't buy as much in 2020 to 2024? It is because you can get bargains. And CBRE, a major lender in the commercial real estate space, has always said apartments outperform stocks and bonds, partly because the returns are stronger, rents grow over time, and values grow with good management. But it's also, there's tax efficiency, tax benefits that stocks just don't have. There's income and revenue, rent growth from 6% as I get to as much as 8% on apartments that you just can't, it's hard to get that out of stocks as well as the growth. So what people like about it is it gives them the opportunity to have more of their monies coming back in the tub so the tub doesn't drain out. So you have something you can will to your children. And that's why Cory and I focus on investment opportunities with superior passive returns, superior tax benefits, and superior capital preservation. That's why we are doing what we're doing. There's a mission behind the math. Both Cory and I were brought up to be stewards of whatever it is that we have. If that's money, if that's our money, if that other people's money is our health, our marriages, our children. The mission that we're excited about is that 94% of apartment residents are unchurched, representing one of the most accessible mission fields in America, and more than 50% of residents in B and C class properties, which is not the brand new ones, but the ones that are affordable, cannot name 2 neighbors nearby that they could call in an emergency after 9 p.m. to keep their kids if they had a fall and they were rushed to an emergency room, and that's a problem. The 2023 Surgeon General report called it a loneliness crisis or a loneliness epidemic. The over 30% of these apartment dwellers self-diagnose, they just call it depression. It's really just a loneliness crisis. So if we can connect them by having resident appreciation events and monthly socials, we find that our word of mouth leasing goes up, your turnover goes down, we drive down our turnover costs, our renovation costs. We drive down our marketing costs, and people actually like it once they get to know their neighbors. They want their friends to live there. Here's an interesting thing: 35% of America today rents, and if you're buying properties, you get to take the 100%, whatever you get to depreciate over 27 and a half years, you get to do it the first year as of July 2025. So while we're building true communities, we are improving the net operating income as well as improving the lives of residents. That's something we get excited about. We call it impact investing. And where we buy is high growth markets where employers and people are moving in all the time. We do the value adds to the properties. We improve the operations, and it's driven performance by natural growth in North Carolina and South Carolina markets like the Charlotte metro area, like the Greenville-Spartanburg area, Tennessee East as in Knoxville, and Texas, Dallas-Fort Worth as in Anna, Texas, and Sherman, Texas, and those communities that are in that area. And we're buying pricing gaps, correcting those operational inefficiencies. We only pursue the assets where mispricing is caused by capital structure. We're not buying on hopes. And again, we're stewards. Cory, I would ask you, were you not like I was taught that we must serve as unto God, not unto men? What do we do wholeheartedly? Is that something that resonates with you, and how do you think that affects us when we do impact investing?
Dave, I love it. It's part of who I was taught to be by my dad, and it reminds me, I don't know if we'll touch on this a little bit later, but just the great opportunity we have to live in this country and to have the freedoms we have and to be able to do what kind of we want to do for the most part. And I know that the greatest joys in my life come when I mentioned earlier, teamwork, working and helping people grow and get to the next level wherever they are. I've done it professionally as a CPA, advising and helping people get to their next level, reach their goals, go through challenges, whatever's in front of them. But at the heart of all that, the reason, and I'm glad my dad taught me this, that there's a satisfaction that comes to me personally. It's ironic, but when I'm helping someone else, often I help myself more than I can help them. Meaning they move forward, but it seems like sometimes I get more benefit and more wind in my sails, so to speak, from going and helping. So the stewardship concept is something that means so very much to me, and it's one of the things that gives me the greatest joy.
Well, and I would agree with that and tell you that when my son moved away 4 hours away to go to high school at age 16, we were worried about him. But that school practiced intentional, caring, connected community. They had a lot of icebreaker games, shared meals, goofy games, a lot of things like that. They would ask the kids, the students, to ask each other, how you doing really, and listen, and then say something affirming to the person and care about other people. Because of that, their sense of belonging was met. All of the kids thrived. My son is completed a master's at Columbia, is working on a PhD at Columbia University, is pledged to go to work for a quantitative trading firm. All of his peers did similarly congratulatory things, but I think largely it's because they felt connected and they felt appreciated. And so that's something that we do. A study of 55 communities from Arizona to Georgia over 4 years found that operators who invested in intentional, caring, connected communities and resident connection and appreciation found that the average income increase of net operating income was 138,000. In some cases, it went to 180,000, and that was without touching rents, but just improving the lives of the residents. And then they wouldn't move out nearly as much. They started staying more of an average of 7 or 8 years. So part of being a steward is impact investing, and something that we're excited about, and we think you might want to be excited about as well. The markets are competitive out there, and so we're not the only ones bidding on these. And so disciplined capital is positioning now, not really waiting. I want to show you an illustration of a property that I closed on in November in the northern Dallas-Fort Worth area. It's a 31 unit. It could become a 32 unit, but the structure and compounding, I want to show you what it would be like. I had a friend in New York and Long Island ask me, Dave, I'm a 72-year-old retired small business owner. What can 100,000 to 200,000 do for my money? So I said, well, let me ask the senior GP, who also served in New York City managing 100 CPAs for 20 years. Let me ask him to draw something up for us and to show how your money can compound. And here's what he drew up. He said, well, let's take the 100,000, makes it easier. Said your return is going to be an average annual return of 19.8%. 1%. We're trying to go above, at or above the average private equity 14.2. We're trying to get people's monies to double about every 5 years. Nonetheless, these are the metrics he's just showing here. They're very similar to what we looked at earlier. But your cash on cash return is going to be just a little under 6%, a little over 6%, and a little over 7% during the hold period. And he asked me, said, well, that looks like disciplined practice. And I sit on all those GP meetings and watch the property grow in profitability. He asked, well, what can I earn in the way of tax benefits? I said, you really need to consult your own CPA for that. We're not CPAs, and we don't know the types of income and all the different deductions that you have on your return. He said, well, do you mind just ask the cost segregation team what an average 72-year-old retired business owner might get? Ask him to be conservative. So we did. The cost segregation team drew this up and said, okay, if you put in 100,000, you're probably going to get somewhere around 34 to 36 cents back per dollar. So about $35,000 to $36,000 back on your tax return your first year, and up to about 50,000 over the 5-year period. And so at the end of 5 years, you will have gotten half your money back in tax benefits, but your money will have gone up rather strongly. So if indeed you are getting your 100,000 to grow up to 195,000 all in, including your rental income and your returns, and you get 50% of it back, then you really have made your $50,000 net investment work rather strongly. And that's why people like it. And since we're coming up on July 4th this weekend, Ben Franklin has a word he wants to tell you, if you don't mind listening.
Do you have to be a teacher's retirement fund to think like this? Do you have to fill your financial tub with only depletion assets, pennies that go away after you do, instead of positively impacting lives beyond yours by accumulating assets that pay you, so your pennies live into perpetuity?
Well, the reason we put him in there, and we're about to celebrate our 250th anniversary, understand that most people, when they will property away, they think who's going to get the house, who's going to get the car, who's going to get the money in the account, who's going to get the silver. Ben Franklin thought differently. He was the 15th child of 17 children who was called out of formal schooling at age 10 to come help his family in his shop. What he did on his lunch breaks was eat 2 pieces of bread and 2 handfuls of raisins and read like crazy. He studied in libraries. He read as much or more than Warren Buffett. He became a super investor. He became an apprentice at a printing shop and ended up buying a newspaper and making it go very profitable, go nuts. And then he franchised and taught other people how to do that, franchised, helped them grow, and it took a percentage of their earnings. He accumulated assets that paid him, whereas at that time, his peers were saying, no, we just save up gold and silver. That's the value. Then we spend it down. And he was like, no, we need to have fiat currency. He was quite the pioneer economically. So I wanted us to hear from Ben Franklin and some of the things he did. He actually willed 1,000 pounds British sterling to the city of Philadelphia and 1,000 pounds to the city of Boston. And he had a rule on these monies when he passed. He said, you have to use this for charitable causes, charitable purposes, such as microloans to apprentices to get their businesses going or their homes at low interest rates. And you cannot touch the principal. You cannot deplete it for 100 years. After 100, you can deplete it for a charitable worthy cause, but you have to let the rest of it grow for another 100 years. He had a 200-year plan, 2 centuries, and he was 83. He knew he'd be only around for months. He knew that other people would park under the trees he was planting. But over $5 million was the value after 200 years just for the city of Boston. So the point is, Ben Franklin had a long view, and he was trying to teach America some things, and that you need to acquire assets that pay you, and that's what we're trying to do. Our hope for the future is that partners get to benefit every year. The ones that do, they're very happy campers, very happy investors. They like receiving their monthly returns. Partners benefit long term. Capital gains are deferred by exchanges if that's the way you want to do it. If you're doing it inside of a Roth 401k or a Silver 401k or a Roth IRA and that sort of thing, then you already have tax advantages there. This is a great catch-up retirement strategy with average annual income, strong and midterm growth and long-term growth. So your capital compounds more efficiently. And a surgeon friend of mine who wrote a book called Wealth by Design showed that this is what happened to his net worth by investing in these commercial assets like that. So for the next 12 to 36 months, we're preparing now to take advantage of the bargains that are coming available. So if any of this resonates with you, the next step is a private conversation. We typically pre-fund each investment with just 6 to 10 investors. The average investor is usually in for 150 to 200,000. But if you have an interest in that, I'm David at chateaucapital.fund or Cory at chateaucapital.fund. And at Chateau Capital, we invest carefully so that you can earn more, worry less, passively and repeatedly. And if you'd like to scan my OVU business card, there's a QR code there, and there's a link that you can get on my schedule, and we can continue to communicate. Since it is July 4th coming up, I want Ben to say one more word for us, because if you do invest in assets that pay you, then you won't have the anxiety that I watch my parents and my in-laws go through right now. It's not that they haven't saved up enough money, not that they didn't plan. It's just it was all in growth stocks and monies you have to deplete. And what happens that flows out of your drain is inflation and taxes and larger assessments and larger utility bills and the car that breaks down and the grandchild's tuition and the healthcare expense that wasn't covered and on and on. And I see the anxiety that causes instead of having assets that pay you. If you do that, you find that you go from gripping to being open-handed, or from being anxious. If you have assets that pay you, you tend to be more generous. You tend to think like Benjamin Franklin did, the 15th child of 17 kids, who found pennies hard to come by. But he invested more in America and willed and gave more away than almost anybody. He became one of the wealthiest persons in our colonies in the United States. He signed the Declaration of Independence. He signed the Constitution, one of the few who lived to tell about it. But because he was a thinker, financial thinker, I'm going to let him give you this word for you.
Now it is your turn. Don't depend on a depletion model. Think beyond your years and of causes you care about. Your pennies can live in perpetuity. Bless others with your plans and your decisions. Write it down. If you do, I assure you will love your life so much more, enjoy your years so much better, and leave a legacy that shines as only your legacy can. And as you celebrate this year, imagine the impact your decisions can have on our 300th year anniversary, because you decided to bless them, and as I did, you wrote it down. Then, as mine did, with generosity, watch your pennies reach into perpetuity.
Ben Franklin's pennies became millions over time, just simply by having a long view. We're going to go into a question and answer session, and one of the questions I get over here is, what do you guys do to avoid the challenges and problems of the storms and the pandemics and that sort of thing? We have something called the STEADY framework that we came up with. STEADY, S, stress tested underwriting. Cory's great at that. Thoughtful capitalization. Cory's great at that. E, experienced operators and local execution. Asset selection with a margin of safety. Discipline managing data, and yield with integrity. So we underwrite, and we only buy bargains with reserves. We use the anchor method to protect capital when storms come, and we've been through a bunch of them. A is for assumptions built for downturns. N is for non-recourse resilient debt. C, capital reserves and contingency planning. High quality asset management and risk-aligned structures. And so we believe, in order to get you the returns that you want, in order to buy the bargains, we have to be those who are quite interested in protecting your capital. So we want to thank you for tuning in. Cory, can you think of any other questions you see that on your email or on your phone and text that you need to answer while we're here during this Q&A?
I do not have any that have come in.
Well, we thank you for tuning in today. I'm looking forward to answering any of your questions. If you'd like to have a private session, if any of this resonates, our team would welcome the opportunity to share with you. No pressure, no pitch, just a real honest conversation about where you are, how to make assets that pay you grow for you, and see if this is something that fits in your life or not. The main thing is, as we look towards this celebrating the 250th anniversary, could you think like Ben Franklin? Could you think about accumulating assets that pay you? Could you think about leaving assets that pay others? You can bless people, scholarships, ministries, charities, grandchildren that haven't been born yet. If you do, don't depend on a depletion model. Got my words backwards there, as Ben Franklin said. Thanks for tuning in. We will look forward to answering your questions and speaking more in the future. Have an awesome day from us. Thank you. Bye.